Good morning. It is Thursday, the 20th of March. You are joining myself, Ryan Paisley, and the illustrious Michael Brown for today's morning blast. But before we get underway, let's get the legals out the way. As usual, nothing discussed on this Spaces session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Trainers PIQ or PIQ Suite, or indeed that of the hosts, which is obviously Mr. Paisley and Mr. Brown. What a glorious day it is today, Mr. Brown.
Indeed, it is. Very good morning, Ryan. Good morning, everyone. Happy Friday, happy Thursday,
Oh my
even,
days!
and happy
Well,
Bank
hang
of
on, and
England
I'll
Day
tell you.
as well.
Sorry, I'll tell you why you said that, because you're knowing you work shy skiv. You're probably working from home tomorrow, so technically today's your Friday.
Do you know what? Guess where I'm
You are.
sat right now?
You are home.
I am indeed, yeah.
Oh, I'm getting Zach on the blower.
And I must apologise because some scaffolders have just turned up to erect some scaffolding in my next door neighbours.
Oh
So
God, bro,
forgive any background noise, please, while that's going on.
what? Because I kind of genuinely, what a glorious day it is in the UK at the moment.
It is
And I'm not.
absolutely lovely outside.
And I'm not gonna lie, I did sit in the garden for about 20 minutes yesterday before I had my daily mental breakdown, and I've actually got a bit of a sunburn on.
Oh, Jesus Christ.
Oh well.
That thing
Anyway,
is, that
enough.
doesn't actually surprise me.
No, it's how pale. Anyway, enough about us. What's been going on in markets?
Yeah, well, actually, I'm glad we are moving on because there is plenty to discuss this morning. Good morning, everyone. Of course, all eyes yesterday on the March FOMC policy decision, where the committee, as expected, held the target range for the Fed funds rate steady at between 4.25% and 4.5% in what was a unanimous vote among policymakers. Accompanying that was the updated policy statement, although I say updated, there weren't really many changes to it, to be completely honest with you. The economy was still described as growing at a solid pace, while inflation was again described as remaining somewhat elevated. Notably, the Fed did remove reference to risks around the dual mandate being roughly in balance, though Chair Powell stressed at the post-meeting press conference that this change was not intended to send a policy signal. Mini rant here, that's twice in 2 meetings now that the Fed have changed something in their statement and then half an hour gone, yeah, but we don't mean anything by it. Well, don't bloody change it then
Well,
in that
as
case.
I said the first time, and I genuinely think this is not far off, is Grammarly. Grammarly is roiling markets. But
Well, if
basically, the Grammarly's coming up with a little suggestion. Oh, do you want to change it to this? They're like, oh, go on, then click to that. And some market participants are like, what the fuck is going on here?
if we wait a decade, we'll be able to find out because they'll release the
Yeah,
transcripts, but we'll have lost interest by then, I imagine.
I'll be dead.
Oh God, you'll be sunburnt. You'll be burnt to a crisp. Anyway, moving on. The Fed also unveiled their latest summary of economic projections yesterday, including the updated dot plot. I'm not going to go through all of the forecasts here, but the nub of these projections is that the GDP growth forecast has been revised down across the forecast horizon, while the near-term inflation outlook or profile has been revised higher, though the Fed continued to see both headline and core PCE falling back to the 2% price target in 2027. Of course, there is huge uncertainty around these projections. There was a massively wide dispersion in terms of these forecasts as well, and no surprise, really, considering that no market participant has got much of an idea exactly what the outlook looks like at the moment. It's not entirely surprising that the Fed don't have much of a clue either. In light of that, the median expectation on the updated dot plot was unchanged across all 4 years of the forecast horizon, the first time that has happened since December of 2020, interestingly enough. So that continues to point to a median expectation of 50 basis points of cuts both this year and next, followed by a single 25 basis point cut in 2027, with the Fed continuing to view the longer run Fed funds rate at 3%, which is effectively their proxy for the neutral rate. Among those dots, though, there was a considerably more hawkish skew. Effectively, those who were under the median are now at or above the median, but the moves were not enough to skew that actual median dot higher. And again, Powell at the press conference trying to distance the Fed from the dots quite significantly. Actually, it was interesting that he said that in his prepared remarks and just tried to even head off any journalists asking about it. The other interesting point from the FOMC last night was that they are going to slow the pace of their balance sheet runoff. The Treasury redemption cap is going to fall to $5 billion from the current $25 billion. This had been hinted at in the minutes of the January meeting, but it was not exactly a consensus view. The expectations were that they would slow the pace of balance sheet runoff at the May meeting instead. Interestingly enough, Governor Waller actually would have preferred and dissented in favour of balance sheet runoff remaining unchanged, which I thought was an interesting dissent, given that he actually voted, of course, in favour of rates remaining steady as well. In terms of Chair Powell's remarks, I mean, he very much stuck to the script, to be completely honest with you, not being drawn on anything political or really anything in terms of tariffs, and certainly not pre-committing to any policy path at this moment in time. Again, stressing that the economy and monetary policy are both in a good place, that policy is well positioned, and that the Fed really don't need to hurry to make any adjustments to their policy stance and can frankly just sit on the sidelines and wait until there is greater clarity around what is going on with the United States economy. Powell was also stressing, interestingly, that the decision to slow the pace of balance sheet runoff was, and I quote here, a technical decision. I must admit, I find this framing a little bit annoying. When you're doing QT and running the balance sheet lower, you claim that it's technical, but as soon as you do QE, it's apparently monetary stimulus and it's going to save the world, which I find slightly grating. In any case, the other notable line from the press conference was Powell talking about the potential inflationary impact of tariffs. And he said, he used the horrible, fateful word. He said that their base case is that tariff induced inflation will be transitory. We must all hope that things end
Drink.
up. Well, it was the first time he's used that word at a press conference since 2021. And let's hope that things work out much better this time than they did
The
the
thing is, as
last
well,
time he was using that language.
it's contrary to popular belief. They're not stupid, and they do know kind of how markets and how participants take their language and stuff. So there was probably a discussion about whether or not to use the T word at some point.
Oh, 100%. Nothing they say at the press conference is a mistake. Let's put it
No.
that way, unless it's Christine Lagarde. Anyway, in terms of the overall sort of view on the Fed last night, to be completely honest with you, they have as little idea as anyone else about the economic outlook at the moment. And do you know what I think is quite refreshing? The Fed are actually prepared to admit that. Powell is not going to stand.
Uncertainty.
Indeed, Powell is not going to stand there at the lectern and effectively bullshit us all into thinking he knows exactly what's going to happen, because he doesn't. No one does. And as a result of that, the Fed are firmly in a neutral policy setting. They are going to, with the economy remaining relatively resilient, they're just going to sit on the sidelines and twiddle their thumbs and try and make as little news as possible and wait until they have some greater clarity as to how things are likely to evolve before taking the plunge with another rate cut, because of course the direction of travel for rates continues to lead lower. In terms
So
of
2029 then, yeah.
well, yeah, I'm buying that, to be honest. In terms of the market reaction to the FOMC last night, we did see markets interpret all of that as a relatively dovish meeting, although I would be tempted to say that this was more an unwind of folk who had potentially hedged some hawkish risk around the Fed, as opposed to any fresh positions being taken. Nevertheless, the S&P 500 added about 1%, and Nasdaq 100 up by 1.25%, while Treasuries advanced across the curve, with the two-year yield falling 6 basis points on the day and dipping back under 4%, while the 10-year yield fell around 3 basis points on the day, and this morning trades below 4.25%. Of course, those moves in the Treasury complex likely helped by the decision to slow the pace of quantitative tightening. Meanwhile, in the FX space, the dollar was broadly softer, although the dollar index remained well within recent ranges, despite retesting lows around 103.40 during the press conference. Cable briefly trading north of 130, though we have given up that figure this morning, and the same story with the euro, which popped north of 109 during the Fed press conference last night, but has again given up that advance this morning, unfortunately. Last but by no means least, in terms of market moves, we have seen gold trade to fresh record highs overnight, 3,050 $57 an ounce is the high that we have during the Asia session. At least that's it, according to Bloomberg. And of course, that is fresh record highs. In terms of other bits and bobs that have been going on over the last 24 hours or so, it's worth just knocking off a couple of other policy decisions. First of all, as we went to air, the Swiss National Bank, they delivered a 25 basis point cut as expected, lowering the policy rate to 0.25%, with the policy statement that accompanied that decision, again stressing that they are prepared to intervene in the FX market if needed. They also flagged some downside risks to inflation in their latest economic assessment. Also at 8:30 this morning, we heard from the Swedish Riksbank. They held policy steady at 2.25%, with the guidance accompanying that decision noting that the Riksbank believe that rates will stay at this level going forwards. They are effectively done and dusted in terms of their easing cycle. In terms of other bits and bobs, then, worth covering off, reporting via the FT overnight, one for Tom Talks Cars, if he is here, is that NVIDIA is planning to spend, and I quote, hundreds of billions of dollars in the United States over the next 4 years. Very much a nod towards President Trump with those policies.
Just on
Sticking.
that, I see.
Oh, go on.
So the FT have put a number on it because I saw hundreds everywhere, but the FT have actually come up with 500 billion.
Oh, right. Well, there we go. That serves me right for not reading the article, doesn't it?
To be fair, it's the FT, so no one's going to blame you.
Well, yeah. No, you're very true. Is it because of Brexit that they're not investing that in the UK?
Yeah, potentially.
The FT and Brexit is like the Daily Mail and Princess Diana, isn't it?
Oh, what a great analogy. Yes, very much so.
Get that on the old YouTube. Anyway, moving on. Speaking of the UK, The Guardian reporting yesterday that Chancellor Rachel Reeves, who of course makes the spring statement next Wednesday, she is not going to be making any changes to taxation in that statement. The government, though, before you get too excited, have not ruled out extending the freeze on income tax thresholds that they actually canned at the budget 6 months ago, but they've decided that extending that freeze, the decision to do so, will not come until the next budget, which is, of course, in the autumn. I'm still here, yes. Are you there, Ryan?
Yeah, sorry, it's kind of cut out, but I'm not sure if it was you or me. I don't know. But
anyway, I was only waffling about Rachel Reeves, so it doesn't matter too much. Anyway, sticking with the United Kingdom, we had the latest labour market data out this morning, all bang in line with expectations, with unemployment holding steady at 4.4% in the 3 months to January, while earnings, including bonus, rose by 5.8% on the year, excluding bonus by 5.9% on the year. It is worth noting that the Bank of England's Monetary Policy Committee almost certainly had advanced sight of that data before they voted on monetary policy last night, as is standard practice, and that policy decision will be announced at midday, and we'll get onto that in a moment. Other bits and bobs from me this morning, just a couple of stories from the EU, really, before I hand it back to you, Ryan. The first is, according to Reuters sources, the European Union has proposed cutting imports of steel by around 15% from the start of April. Of course, both steel and aluminium becoming very, very hot topics indeed as Trump throws tariffs around all over the place. And lastly, from me this morning, Apple. They've apparently been given another slap on the wrist by antitrust regulators in the European Union, and they've been told that they need to open up their operating systems to rival makers of smartphones, headphones, and virtual reality sets, which I would imagine Apple have absolutely no desire to do whatsoever.
Yeah, I bet. Although as a consumer, it would be pretty handy. Let's be honest.
If I knew what any of it meant, then yes, I'm sure it would be.
Well, we'll see if they can do some like Apple system for your abacus, and like we'll send it down to you. Just to remind anyone that tuned in late, just a reminder that Michael Brown is working from home on a Thursday. He was seen having a beer after FOMC, so rumours that maybe he woke up too hungover to come into town.
Here we go.
Yeah, unfounded at this point. But
you're only saying that because bloody Judith Chalmers has popped up.
Well, that's right. He's only popped up because I WhatsApped him straight away when you said that you were working from home.
You fucker.
I've never seen him join so quickly. But anyway, right. So speaking of Zach, aka Judith Chalmers, who's on another holiday, thankfully he is still providing the overnight news roundup. So some choice headlines from that. Obviously, check it out on the Substack. which is obviously found in our pinned tweet as always. But starting off with some macro and some policy news, reiterating again what we heard yesterday, the Turkish turmoil. Istanbul mayor, not going to pronounce his name, Erdogan's main political rival, was arrested on corruption and terror charges. The Turkish stock market after this hit limit down, bond yields rose, and the lira plumbed new lows against USD. Haven flows serviced in broader markets. Pardon me. Trump's policy signals. The president posted on Truth Social for Fed rate cuts ahead of the planned April 2nd tariff shift, calling it Liberation Day.
Jesus
Trump says
Christ.
India. Yeah, right. I can't wait for liberation fries. That's what we were on about before, right? Freedom fries and all that crap. Trump says India will probably slash tariffs, yet the US will impose matching duties on April the 2nd if they do not. US shipbuilders face uncertainty as the White House plans to charge steep fees on China-linked vessels, creating some shipping scarcity and swelling coal inventories. Just want to note on this because the awesome Angie, who I do the grain market blast with every day, like midday London time, she's been banging on about this China linked vessels port fee thing for quite a while, and finally people are picking up on what a big deal it could be. So anyone that's not aware, potentially there's going to be some port fees linked to any fleets that own US ships. So if you're an exporter, say you're a grain exporter in America, you could be paying up to, say, potentially another 50 cents a bushel per bushel if the exporting ship that you're using to, say, send it to China, if the people that own that ship, so that ship itself doesn't have to be Chinese made, but if the fleet that it's part of is over X% made by China, then that ship itself will also incur a penalty. It's quite convoluted, but it could have quite a serious impact on US exports and also just US port kind of coming and goings regardless. So it's definitely one to keep an eye on, and it's something that's definitely flying under the radar. But anyway, oil execs met with Trump seeking faster permitting rather than focusing on weak crude prices, said the Interior Minister. Obviously, we know that Trump's a big fan of drill, baby, drill. Fentanyl and overdose deaths. The CDC data, US overdose deaths fell 25% year on year in the 12 months ending October 24, mainly due to a few synthetic opioid fatalities. Reminder, this is data from before Trump come in, but it is a very hot topic for Trump. So one as well to keep an eye on this data when it does keep trickling through. Australia, New Zealand. Australia's job reports disappointed, pushing the probability of a May RBA cut to 78% from 70%. The Kiwi economic data shows it exited recession with only marginal growth. Pockets of weakness dampened investor reaction. Weird one that Kiwi economy seems to be outperforming the Australian at the moment. So again, one to keep an eye on for the antipodes.
Well, it is.
China.
I was a bit of context there. Of course, the Kiwi economy has just contracted by about 2.5% in the space of 6 months in the middle of last year. So it is coming off a very, very low base, of course.
Yeah. And also over COVID got absolutely hammered. But yeah.
And the only thing that's there is sheep, but you know.
So it's not all bad. Anyway, sorry for the Welsh listeners out there. China PBOC kept lending rates unchanged. The 1-year LPR at 3.1, the 5-year LPR at 3.6. Chinese stocks broadly pulled back despite a risk-on move in the US. Tech giants Tencent, Alibaba, etc. lagged after recent outperformance. China's youth joblessness rose for a second month. Official jobless rate also climbed to a 2-year high. A reminder, Chinese data. So if they're admitting to this, it's dire. I do remember last year some Chinese professor put out something saying that youth unemployment could be as high as like 60% or something stupid. I'm genuinely not messing around and not joking here. I'm pretty sure, if I remember correctly, that this same person then disappeared.
I was going to say he hasn't been seen since.
No, I know. Genuinely, I'm pretty sure he disappeared. Beijing ramps up mineral exploration support for resources self-sufficiency amid Sino-US competition. Chinese bonds advance further on short-term funding support from the PBOC. Mainland share prices versus Hong Kong listings nearing a 4-year low gap. UK fiscal and economic. As Michael said, Chancellor Reeves reportedly plans bigger spending cuts since austerity. She's aiming to plug the budget gap via deep Whitehall budget trims, but ruling out major tax hikes. So major tax hikes it is. Reeves is said to have assembled a 5.9 billion fiscal buffer via spending cuts, reallocated foreign aid to defence and welfare savings. Bond sales in the UK could reach 310 billion in the next fiscal year, ex-COVID record, testing investor confidence in Reeves' approach. UK wage growth remains high and employment rose, keeping the BOE wary of further cuts. That's according to Bloomberg. Options traders that are playing around with gilts pretty much have placed large bets on more than expected BOE rate cuts, 3 versus 2 priced in by markets. That's by year end. What else we got? Canada, EU, etc. So Canada responding to US tariff threats and talks of annexation by buying Canadian retailers quickly adopt the movement. So basically, shops are gonna be filled with maple syrup, I assume. What else do they make?
Oh no.
ECB's Lagarde says there's a hypothetical 25% US tariff on EU goods could shave 0.3 percentage points from the euro area growth in the first year. Germany's industry lobby wants more flexibility to refill gas storage and cushion high energy bills. I'm guessing this is a very subtle way of saying we want to start buying Russian gas. German sticking with the EU, France plans a 450 million euro defense fund by state lender BPI France. Poland is exploring a multi-nation defense procurement with the UK to maximize budgets. Emerging markets briefly, Brazil's central bank hike rates by 100 basis points again, but signals smaller increases ahead. And finally, on markets, the New York copper prices hit a record premium over LME copper amid rising US tariffs. Anyone seen that chart? It's a doozy because New York and London copper have basically been going pip for years. As soon as Trump takes office, obviously the Shrewdies realize there's a high chance of tariffs on copper being imported to the US, and the New York copper price has left the London price for dead. It's a great chart if anyone can dig it out. Few on geopolitics now.
Go on then. While you're waffling away, I'll go and dig that out.
Yeah, go on. Thank you. Chop. Go make some tea for the scaffolders. Ukraine and Russia. Zelensky says an energy strikes halt may come soon following discussion with Trump. Hungary to veto further EU attempts to rapid Ukrainian ascension or military aid. Israel, as everyone must have heard this already this morning, but Israel ground operations have expanded. Apparently, there's been a lot of fatalities already, so we're again want to keep an eye on if that's kind of this war, conflict, whatever we want to call it, is going to re-escalate. Chinese social media sees increased calls for a hypothetical invasion of Australia. Okay. And finally, for me, in corporate news, obviously Michael's spoke about NVIDIA. CoreWeave is obviously related. Eyes an IPO at $2.3 to $2.7 billion, priced at $47 to $55 per share to capitalize on AI data center demand. SoftBank to buy US chips-based designer Ampere for $6.5 billion, furthering its push into AI-related hardware. What else we got? Kraken Exchange, the crypto exchange, is near a $1.5 billion deal for futures retail platform NinjaTrader, aiming to diversify into other asset classes. BlackRock, Chinese office complex once owned by BlackRock-led fund, is poised for a sale at over a 40% discount, implying losses for BlackRock and its lenders. And finally, for me, let's pick one final one. Swiss watch exports. The downturn trend resumed in February. Major markets are declining. The clock is ticking on that one.
Oh, you fucker. That's exactly what I was going to say.
No, you got to zoom in on that chart, mate. That's shit. You know, zoom into the most recent bit.
Sorry,
I'll put it up in the jumbo. Right, carry on. Right, back to you in the studio.
Trying to co-host a call here, not mess around on bloody paint for you. Anyway, it tells the story. You can see the disconnect. Just get a magnifying
Yes,
lens
it
when you go
does.
and have a look at it. In terms of today, then, there's a few bits and bobs actually worth bearing in mind on the economic docket as we move through this sunny Thursday here in the United Kingdom. Kicking things off at midday, we have the latest policy decision from the Bank of England, where the Monetary Policy Committee are set to hold bank rates steady at 4.5%, having delivered a 25 basis point cut at the last meeting back in February. Accompanying that decision to hold rates steady is likely to be policy guidance that broadly reiterates that issued after the prior decision, with the MPC as such repeating that they will follow a gradual and careful approach to further monetary policy easing, while also noting that policy must remain restrictive for sufficiently long to bear down on the risk of persistent price pressures, as well as continuing to take a meeting by meeting approach to future rate decisions. The vote split, though, is likely to be of interest for the BOE this time around. If you recall back at the February meeting, we had two policymakers who dissented in favour of a larger 50 basis point rate cut. Those, of course, being the BOE's uber dove, Dingra, and also Catherine Mann, who obviously flipped from being an arch hawk to an arch dove at the turn of the year. This time around, there is
Man.
really. Sorry, what on earth was
Sorry,
that
sorry.
noise?
I just started singing.
Oh, God. Jesus, please stop. This time around, to be completely honest with you, there is absolutely no consensus whatsoever as to where the vote split may fall. I've seen guesses from 8-1, as in 8 for unchanged, to and 1 for a 25 basis point cut, all the way through to 5-4 for unchanged, with a couple of those four instead dissenting in favour of a larger 50 basis point cut. The three that are, in my mind, have the potential to dissent are, of course, Dingra, potentially Catherine Mann again as well, and also external member Alan Taylor, who has been sounding pretty dovish in recent remarks too. I think the key takeaway, though, from the vote split is likely to be that none of the internal members on the MPC, so the governor, the three deputies, or the chief economist, are favouring further rate cuts at this moment in time. On the subject of Andrew Bailey, do bear in mind, of course, that there are no new economic forecasts due from the bank this time around. There is also no press conference due either, though there is the potential for the big man himself to pop up in the media at some point throughout the afternoon. In terms of market pricing for the Bank of England, the OIS curve prices absolutely nothing for today, while pricing about a 70% chance that the BOE deliver a cut at the May meeting. The next 25 basis point cut is technically fully priced by August, but with 23.8 basis points priced for June. I think it's safe enough to say that markets are expecting a cut then. We do have around about 54 basis points of easing priced in the curve by the year end, with the sell side consensus seeing the Bank of England delivering 3 25 basis point cuts by then. In terms of other bits and bobs to keep an eye on today, we do have a few notable releases from the United States. The the weekly jobless claims figures will be released at 12:30 London time this afternoon. Initial claims expected at 224,000 in the week to the 15th of March, up from the prior 220,000. Of course, that week coinciding with the March non-farm payroll survey week. Continuing claims, meanwhile, for the week to the 8th, they are seen rising to 1.887 million from a prior 1.87 million. Also at 12:30, we'll have the latest manufacturing figures from the Philadelphia Fed. That index expected to fall to 9 from a prior 18.1, and of course comes after that dismal New York manufacturing figure that we received on Monday. The US
Dismal.
also gives us new existing home sales data at 2 o'clock this afternoon. Other than that, a few other things worth keeping on the radar. We do have plenty of central bank speakers throughout the day today. We've already heard from the ECB's Lagarde. She will be giving testimony to the European Parliament throughout most of the morning. Her ECB colleagues, including Centino, Muller, Lane, and Vilroy, as well as the Dutch representative Klaus Knot, will also be speaking throughout the day today, as well as the SNB Schlegel. He'll be giving his post-meeting press conference in approximately 45 seconds time, as well as the Bank of Canada Governor Tiff Macklem, who makes remarks later on as well. On the earnings front, a few notable releases due after the market close in the United States today, including semiconductor name Micron, Nike, Just Do It, and of course FedEx as well. We will see whether or not they deliver. And last but by no means least, just
Oh,
one
God.
for the APAC focused traders overnight tonight. We do have the latest inflation figures due out of Japan. In Japan, CPI is seen rising by 3.5% on an annual basis in February, which would be a slowdown from the 4% pace that we saw in Jan. And that is your lot from me this morning.
Wonderful, Mr. Michael Brown. Absolutely wonderful. I'll let you go so you can go and make a cup of tea for your scaffolders because you are working from home. Just to make sure everyone's aware of this.
They've
Listeners,
actually
thank you so much for
disappeared.
tuning
I
in. Michael
assume they have
Brown.
actually gone to get a cup of tea, knowing them.
Well, if they've done 5 minutes
Yeah.
work, probably. If there's any labourers listening in, I apologise profusely. Please don't brick my house. Yeah, Michael Brown, thank you as always for being just awesome. Listeners, thank you so much for tuning in as always. If you are trading today, keep it tight, and we will see you all. Well, you will hear us tomorrow. So take care and see you later. Bye bye.
Bye.